Oh, yeah, yeah. Had a rough morning. Yep, yep.
One mic echo. We're going to bring this meeting to order. Welcome to the meeting for the Committee on Investments and Land Management for Wednesday, March 9th, 2025. I'm your chairperson, Keone Souza. We have Vice Chair, Mr. John Wahe IV. There's one excuse absent, Trustee Ahuna. Kawi, can I get a roll call vote, please?
Trustee Akaka?
Ew.
Trustee Akina? Trustee Alapa?
Present.
Trustee Galutaria? Chair Kahele? Trustee Lindsay? Vice Chair Waihe'e?
Present.
Chair Souza? And Trustee Galutaria?
Just joined.
Trustee Galutaria, are you there? Are you there?
Yes.
Okay, thank you.
All right, motion passes. We have quorum. Joining the trustees today is Kapohana Stacy Ferreira, along with numerous support staff. I'm going to call on Kapohana to introduce our administrative staff.
Mahalo, Chair, Vice Chair, trustees. Joining us in person and online, we have Chief Operating Officer Kehau Pu'u, Chief Financial Officer Ramona Hink, Endowment Director Ryan Lee, Interim Corporation Counsel Everett Ota, Interim Senior Legal Counsel Nichio Ozawa, Interim Director of Land Assets Lori Walker, Director of Communications Bill Brennan, Interim Information Technology Manager Kevin Chalk, and Solutions Delivery Technician Kelsey Wade. Mahalo.
All right, mahalo, Stacy. All right, this meeting can be viewed live stream on OHA's website at www.oha.org/livestream. If you'd like to testify on any agenda item during the Zoom meeting, please raise your hand when the item is announced. When called upon, please unmute yourself. You'll be given the ability to turn on your camera during your testimony. Once you're finished, we ask that you mute your microphone. We're recording today's meeting for the sole purpose of producing written minutes, which will become the official record of this meeting. In anticipation of potential testifiers, I'm going to read this next part. Public testimony should be limited to matters listed on the meeting agenda and will occur prior to any listed items conclusion or vote. If you begin to address other issues not on today's agenda, the ILM committee chair will call you out of order and direct you to limit your testimony to items listed on the agenda. Testifiers' mics will be unmuted when it is your turn to testify. If you are not audible, you'll be muted. The next testifier will be called. Oral testimony online will be limited to 5 minutes. Your mic will be automatically muted once you have completed your oral testimony or if your allotted time for your testimony expires. Please log off after testifying, otherwise staff may be forced to remove you. All right, we're going to move on to the first item on the agenda, approval of minutes from the Committee on Land Management dated March 5th, 2025. Do we have anyone signed up to testify on this item?
No one is signed up to testify.
All right, can I get a motion to approve?
So moved, Mr. Chairman.
All right, motion made by Trustee Wahe, seconded by Trustee Akina. Can I get a roll call vote, Kawi?
Trustee Ahuna's excused. Trustee Akaka? Trustee Akina?
Aye.
Trustee Alapa?
Yep, yes.
Trustee Galutaria?
Aye.
Chair Kahele? Trustee Lindsay? Vice Chair Waihe'e? Chair Souza?
Aye. All right, motion passes. Moving on to unfinished business. Seeing none, we're going to move on to new business. We'll be deferring this agenda item for the record. This will be moved to the April 2nd, 2025 meeting. We're clear on that, members? All right. We're going to move on to the next item on the agenda. New business. PIMCO, educational discussion, private credit markets by Jason Steiner, Managing Director and Portfolio Manager, Kevin Gray, and Bill Murphy. We have them in the house, so guys may come to the table. Aloha, guys. Anyone signed up to testify on this item?
No one signed up to testify.
Okay, mahalo, Michelle.
Very good. Yeah. Aloha.
Aloha.
We'll get started. First, thank you for the opportunity to be here. Quickly introducing the team. Myself, Kevin Gray, approximately a 20-year veteran of PIMCO. I've had the opportunity to work here on the islands for about the last 10 years with various clients, which we can talk about. My colleague to the far left here, Bill Murphy, and I are the institutional relationship team for OHA and the other clients here on the islands. As was introduced, we have Jason Steiner here, who's a partner of the firm, portfolio manager in private credit markets, for our discussion on private credit. And just to provide some context, and turning to slide 4. There you go. Quick context on PIMCO's footprint in private credit. So we manage, what you don't see here is we manage about $160 billion across public pensions, sovereign wealth, and nonprofits across the United States, clients in all 50 states. Today, we're going to talk about private credit, and it's largely been one of the fastest growing conversations across our client book. It's been one of the hottest areas in investment markets over the last 7-8 years. So we're really excited about it. And this goal is really educational based. It's not meant to be a big PIMCO commercial. So our time is your time. So please ask questions throughout. We can hold them to the end. However you want to operate is great for us. Really, the idea is to be here to provide some context, because when you say private credit, it means different things to different people. There are some core tenets of private credit, which Jason will get into, and I think will be helpful. One comment I want to make on this slide, we have had the good fortune of managing assets on behalf of OHA since 2018 in what is called our Tactical Opportunities Fund. It is a public and private investment vehicle. So if you see that solid blue box in the upper left corner of the chart, public-private, that is where TAC Ops resides within the PIMCO ecosystem. With that, I'll pause. If not, I'm going to turn it to Jason if no questions, and we'll kick off with some education. Yeah.
Thanks, and thanks everyone for giving us an opportunity to speak today. So I'm going to start off with what is private credit, and what is what do we mean when we say investing in private credit? So first off, investing in private credit means effectively disintermediating the banks. It means going directly to borrowers and extending them credit through loans without having a bank or other intermediary involved in the origination of that asset. Historically, private credit, as Kevin mentioned, has been a very quickly growing asset, and that's been we go to the next slide, please. Where private credit has really historically lived has been in the corporate space. This is an opportunity that's come about in what's called direct middle market lending. And it's really an opportunity for companies to lend to or to borrow from non-bank financial institutions that are looking to get exposure to the asset class without having banks sit in the middle of that. If we go to the next slide, what's driven the growth in private credit? Private credit has really grown about much quickly post the financial crisis as a result of a lot of the the regulations that have been put into place on the banks. That's made it very expensive for banks to directly lend to their customers, and has allowed for this kind of disintermediation activity to really grow. We have a lot of acronyms on the slide at the bottom, things like Basel and CECL. We're not going to go into the details of what all of these mean today, but the net effect of these various regulations has meant that in order for a bank to hold a loan on its balance sheet, it has to hold a lot more capital, right? And that capital comes at a cost to the bank. And so there's better opportunities for banks to not lend into private credit, and that's really created a large growth opportunity for non-bank institutions to come in and lend into those markets instead. So again, what are the different types of private credit opportunities that are out there? If we go to the next slide, we'll talk about the different verticals that PIMCO looks to invest in when we talk about private credit. We talked briefly about the corporate credit markets. This is a $2 trillion asset class today, was really almost zero a decade ago. However, What's not, and that's probably the most commonly known or most commonly talked about type of private credit that's out there in the market today. This is direct lending, what's called non-sponsor lending, mezzanine lending, different types of ways in which companies borrow from private credit firms. Again, $2 trillion asset class. What's less talked about is effectively everything else on this page. And as you can see from what's on this page, it's actually a much larger, much more accessible asset class with things that some of which probably look a lot more familiar to some of the people on the committee, and some of the things that are still what we would characterize as a little more esoteric. And we'll try to walk through some examples of the types of investments that PIMCO is making in the asset class. The largest kind of pure play private credit opportunity is actually in the residential credit market. These are mortgages, right? Everyone knows about mortgages. This is loans that borrowers or individuals get in order to finance the purchase of their home, right? So in this market, there's a lot of interesting opportunities. What PIMCO is focused on mostly is the first opportunity in here, which is called non-qualified mortgages. These are mortgages that are given to borrowers that don't qualify for government lending or agency lending, Fannie Mae, Freddie Mac, Ginnie Mae, the type of government-sponsored entities that provide credit to finance most of the housing market. As a result of some of the regulations that we talked about earlier, there's been a large cohort of very high-quality borrowers that were left out of the opportunity to lend into the government programs, and that provides, with PIMCO and other private credit managers, the opportunity to lend to these borrowers and to provide them access to credit. The other kind of broad catch-all opportunity within private credit is what we call specialty finance. This constitutes both consumer and non-consumer types of loans. That would be things like any other non-mortgage debt that an individual that you or I might take out. That could be a credit card loan, an auto loan, student loans for borrowers that are still, in school or just exited university, unsecured consumer credit, and then also more esoteric or less commonly seen or smaller markets in the consumer lending space, things like solar panel lending. If you want to do home improvement loans to improve the value of your home and improve the energy efficiency of that house, you can oftentimes finance the installation of that equipment through private credit lending. In the non-consumer specialty finance side of the market, we're also talking about things like aircraft leasing or tech lending, things that maybe require a little more specialized knowledge in order to access. But we'll walk about an example of that as well. And combined, that's about a $20 trillion asset class. And so it's 10 times the size of the market of what the corporate side of the market is overall, but is less talked about than other areas. And the reason why it's been less talked about is that it was probably the last markets that the banks really started to pull back from, right? Banks were still lending into these consumer markets, right? Mortgage credit has historically been, you go to your bank and you get a loan, right? It was only after the sell-off in interest rates that started in 2022 that banks suddenly, became very concerned about owning a lot of these very long duration loans. Again, most mortgages in the United States, right, are 30-year loans, and they come at a fixed rate. And so it became a very difficult asset for banks to continue to own when interest rates went from 0% to 5% or 5% higher. And banks suddenly found themselves owning a lot of very low yielding mortgages at 3% or less. That really was a catalyst that kind of caused mortgage lending to move more quickly into the private credit lending markets. And that's where we see a lot of the opportunity going forward. The last area of private credit that we're going to talk a few minutes about is commercial real estate lending. This is an area of the market where, if we look at the opportunity set, we're probably less constructive on the overall fundamentals, at least within some subsegments of the private credit markets. Obviously, areas like office have had challenges with real estate valuations, but also there's some other areas of the commercial real estate markets where the fundamentals haven't been as strong as where we have seen other opportunities in the market. That said, there's still opportunities for us to kind of pick and choose our spots where we can see real value here. So broadly speaking, this is the large opportunity set. And so what we're trying to do when we invest in private credit is to find the best relative value across all these opportunity sets, right? And allow us the most flexibility to manage strategies that can invest in as broad an opportunity set as possible. And the idea behind a lot of the consumer assets is that Unlike other forms of direct lending, mortgages, credit cards, auto loans, when borrowers make payments on those loans, a portion of that payment every month that comes in is the principal balance on the loan, and a part of it is the interest payment on that loan. It's called an amortizing loan. It basically pays off on its own without waiting until the maturity date to pay it off. That's a really powerful tool within private credit, because one of the things that you're giving up by investing in private credit is you're giving up a little bit of liquidity, right? When you invest in other markets, right, you can find a bid ask in the market, you can sell your asset. The private credit markets are generally a lot more illiquid. And so there's a handful of risks. I mean, again, we're looking for investments where most of the spread that we're earning is spread that's related to the illiquidity of the asset itself, right? And so the biggest risk is that the liquidity conditions change overnight, right? And that markets that are already illiquid become a lot more illiquid. And so the spread that you want to earn, what you want to compensate yourself for giving up some liquidity in the market. If you're relying on, daily liquidity in your portfolio in order to, invest in this asset class, right? You'll be surprised when liquidity conditions get very challenging, such as, during COVID, when, the markets kind of got dislocated. So the number one risk is making sure you manage liquidity, or kind of the liability and the asset mismatch correctly, so that you don't have, forced selling into a market. The other risk that investors sometimes get wrong is just the fundamentals, right? You want to be careful about investing in asset classes where you don't have a liquidity, because you may be tied into that asset class for a long period of time. The way that we think about this also is to try to have strategies within private credit that are broad, and offer a lot of flexibility in order to invest it across many different types of assets. We've seen other strategies that managers might have that are very narrowly focused in very esoteric asset classes. If the relative value of the asset class changes, or the fundamentals change in that asset class, if that's the only asset class that the manager is allowed to invest in, right, the manager is going to make one of two decisions: either to not deploy capital into that asset class, and the investor might be disappointed because their capital didn't get put to work, or they could put more money into an asset class and have investment performance that actually trails other investments because it's richer.
Right.
So you mentioned about interest rates. What do you
So generally the return expectation.
Yes, so interest rates, I wanted to know, what are we looking at?
Yeah, so generally private credit strategies, we're looking to target within our strategies 8 to 12% returns over a long period of time. A lot of the strategies that we launch today are also income producing. So you get a quarterly or monthly dividend. One of our flagship strategies, we have about an 8% dividend right now. So you're trying to get a high source of income, and stable outcomes and stable returns over a long cycle.
In one of the ways, I want to go back to your question on the risks, because I think Jason mentioned illiquidity as one of the primary risks, but one of the ways that's addressed is through that term or the structure of the vehicle you invest in, and many of these vehicles, be it PIMCO or otherwise, have a lockup period when you invest. It might be 2 years, it might be 3 years, to ensure that all of the investors in the vehicle have the same line of sight, if you will. So the money is going to be captivated for 3 years effectively, and that reduces some of that risk of illiquidity.
Okay, so if we go to the next page, I think we're gonna the next minute or two just.
Sorry, one question. What would the cycle be in the private markets? How like private equity, I mean, looking at a potential 10-year period, what would the cycle be for a private market investment?
So we try and manage our portfolios to an average life of the portfolio about 3 to 3.5 years.
Okay.
Right. Now that's shorter than some other strategies. The average life of a direct corporate loan in the private credit markets could be about 7 years. Right. So we try and invest in strategies that have shorter returns and higher cash flow, so that you can, rebalance the portfolio on a more frequent basis.
Okay. Thank you.
And some of the vehicles as we talk about the terms or the structures of these types of investments are evergreen in nature, meaning they're perpetual, or sometimes they're vintage, meaning it's a 2025 fund. And so you can only invest in the year of 2025, and then the money would be locked up for, say, 3 years before it starts to pay back. So just a bit of a nuance to private credit that you have both vintage or evergreen structures.
Okay, great. So the last thing we'll talk on today, and we'll open up to any other questions, is a little bit about a trade example that we're looking at in the market today. This is within the aircraft leasing space. This is a market opportunity that we found very compelling since COVID. Obviously, if you think about the immediate impact of COVID for the aircraft industry, it meant that airlines that generally owned planes suddenly found themselves with a lot of planes that were on the ground and not a lot of revenue, right? There was no air travel. And so as the airlines tried to manage their portfolio, they said, well, let's try to find ways we can get some liquidity on our aircraft itself. And so the structure that we generally look to invest in is we buy planes from airlines and then lease the plane back to them. So they get the cash on day one, and they pay us the lease payments over a period of time. And so that transaction of moving them from a asset heavy model where they owned a lot of assets to an asset light model transfers the value of that hard asset, the airplane itself, from the airline's balance sheet onto our balance sheet, or the fund's balance sheet. And then we collect a premium every month for managing and for owning that plane, and that the airline will continue to pay a lease rate for us for operating the airline. Aircraft leasing has had, over the last 5 years alone, a number of other periods where the liquidity has been challenged in the market, and where owners of planes have been looking to transfer from being an asset heavy to an asset light model. Obviously, COVID was the first main catalyst in the last few years, but there's been other challenges in the market, be it global conflicts, and then also recently, obviously, lots of concerns about bringing new aircraft to the market. And you've heard a lot of the challenges that like Boeing and other airlines have had with bringing new airplanes onto the market. That actually creates a very strong technical basis for the value of the existing airplanes to stay high. One of the risks of investing in aircraft leasing is that suddenly the airlines start putting a lot of planes on the market, and the value of the planes on an aggregate basis starts falling. You just end up with more supply. But when we look at this market, obviously, new aircraft technology, right, takes a long time to develop. Developing any kind of new engine or new plane takes a long time. And also, the planes that they've been able to bring to the market have also had challenges and had risks to the consumer as well. So it's a market where the existing supply of airplanes has a very long life and a very stable value. And so we feel very comfortable in lending into that type of market.
So with the recent crashes lately, so how does that affect the market?
So what it means is that we look for investing in older aircraft, right, that have long histories, and what it means is that the average life of a plane, right, the typical aircraft probably has like a 20 to 30 year shelf life, right, before they start to cycle it. The average lease on a plane might be as short as 10 years. So what it means is that if you're the owner of the airplane, in the past, maybe you got 2 lease cycles out of it before the plane became obsolete. What it means now is that now you're seeing a 3rd cycle of leasing available to you, and all of that is actually additional profit above the price of the airplane that you're paying for it. So the value of the aircraft has been more stable and more reliable, and the average life of the planes that are in the fleet, the global fleet of planes, is getting older and older.
So there is in that respect, as the planes naturally age out of the system and so forth, does that create any type of, I should say, years of the longevity of these planes that are out there, and you're investing in it, and how's it going to affect us in the long run?
Well, I think the good thing about the older planes is that the older planes have had long cycle, and there's lots of supply of them, and the maintenance on those planes is actually really well understood. And so we see lots of opportunities. We're not talking about planes that are 50 years old. We're talking about planes that are all within the last 20 to 25 years, second lease planes. So we're buying planes that are like 12, 13 years old, not planes that are 30 years old. Right. So the last page that I'll cover, then we'll turn it over to Bill, just goes over kind of some of the economics. So here, this is a type of opportunity that we see, an investment that we made. Again, one of the other characteristics of a lot of the strategy that we talk about is the benefits of diversification. This particular strategy, we were able to deploy capital into 22 different aircraft. So not only do you have exposure to the sector, but you have exposure to the sector in a diversified way, where maybe those 22 planes are leased out to 20 or 17 different airlines themselves. So you mitigate some of the risk that a single airline goes bankrupt or a single airline has an issue. You'll generally benefit from the portfolio diversification benefit. We underwrote this portfolio to a 9% unlevered return, and think that with some financing that we have available to us, that this will underwrite to about a 15% return for investors over some period of time.
And just going back to slide 7 quickly, I think important to note, this is, if you see, is in kind of that purple segment under specialty finance, just one of the many opportunities. We just wanted to highlight one as an example, and aircraft being one that most are very familiar with.
Great. Well, maybe if I could just sum it up, if we turn to page 10, why should you all as long-term investors care about private credit? 3 points that we would leave you with. Jason mentioned in response to one of your questions, the attractive yields and ability to distribute income, ability to distribute capital within private credit, kind of over and above what you see in public markets. Whereas in, a multi-sector public credit portfolio, you may have a yield of 7%. In a high quality private credit diversified portfolio, you may see a yield of 11%. With respect to income that we could distribute on an annual basis, whereas in a high quality multi-sector public credit strategy, you might see a 6% income distribution. In a similar risk private credit portfolio, you might see an 8% distribution. So in the current market environment, really attractive kind of yield and income advantages within private credit. This is a defensive asset class, right? We're typically focused on senior in the capital structure, secured by hard assets, amortizing structures that naturally de-risk over time. So you're not taking significant risk of capital impairment here. There's risk of mark-to-market changes in valuations, but in terms of getting the initial capital that you invested back, we expect to do that in a vast majority, 99% of the time. Finally, these are privately negotiated structures. You're taking advantage of our partnerships with, loan origination platforms, with banks that we've, formed relationships over time to, get access to, confidential private structures. These, return streams are generally idiosyncratic. Many times they aren't related to the other risk factors that you'll have in your portfolio, like equity market drawdowns, interest rate changes, things like data center equipment leasing, right? That's not, the S&P level doesn't really matter there. Those leases are in place. That capital is contractually coming in. Things like music royalties, litigation finance, all part of that opportunity set. Very idiosyncratic risk that's not related to the other factors in your portfolio, which from a portfolio construction perspective is very attractive. So I'd say there's a lot of reasons that this is an opportunity set that we think you should be excited about.
And with that, we're happy to take any additional questions that the group may have.
Awesome, great presentation. Members, any questions? Chair Kele.
Hey, thanks, Chair, for putting this together. It's super informative, especially for somebody like myself who's fairly new to the board. Mahalo, gentlemen, for coming. We really appreciate your time and your expertise. What portion, and I apologize for the question if it doesn't apply, but what portion of private credit under PIMCO's management is part of our Native Hawaiian Trust Fund and our current investment strategy?
Sure, it was on slide 4. I believe it was slide 4. There you go. So the Tactical Opportunities Fund lives in that upper left quadrant under public and private. So that fund is a hybrid credit strategy, meaning it invests broad strokes 50% of its assets in public securities, so liquid credit, daily liquid credit, and then the other 50% is in private markets. And within the private markets, much of what Jason has covered on that opportunity set slide would be available to the Tactical Opportunities Fund. So a number of those, aircraft being a perfect example, is a part of that opportunity set. It's a part of your portfolio today.
Perhaps it's worth bringing Ryan in the conversation here. I know Ryan's the person who, overseeing the investment with us, and is most familiar with how it fits into the, OHA's portfolio.
Thank you. I believe your question refers to the exposure within the current trust portfolio. So with the PIMCO strategy, it currently sits within the diversifying bucket, which is our so-called hedge fund bucket, because they can do both public and private credit markets on an opportunistic basis. The exposure is about 36 million. So that's a good allocation within that diversifying bucket.
Well, it was, so since inception, it's done about 8% in 2018, which the 8% is quite strong, particularly when you think about the economic environment we went through where rates were at near zero. So earning an 8% is very attractive. Last year, it returned just over 14%. So, but over time, it's done quite well.
I guess last question, Chair, is so Ryan, obviously you're integral in that piece, but in terms of reallocating OHA's exposure in that particular bucket, that diversified bucket, are those recommendations that PIMCO makes to Ryan, or how does that work when it's time to readjust, or if the market looks more favorable in the near future, we want to invest more resources into that?
I can speak. Part of it is working closely with PIMCO in terms of the opportunities, right? So if there are opportunities that they see that makes sense for the portfolio compared to the rest of the portfolio, it's a discussion that we would have, and we would make a recommendation to the board to allocate more to, right? So it's a collaboration partnership in terms of understanding what the opportunity set looks like.
What was our initial investment? If it's worth 36 million now, and we first started in 2018, is that what you were saying?
It's a good question. I'm going to say off the top of my head, it was.
Sounds like we haven't lost money.
No. It was not quite 20. It was approximately 20. I'm looking on the cap statement here.
And we're able to add more to the commitment to increase the exposure, given the opportunity set.
I'm just wondering, have we added more to it since 2018, or we've put in this lump sum? This is what it's grown to, or have we adjusted that allocation?
So we have adjusted allocation when it came aboard. We need to increase our exposure within diversified assets. Private credit opportunities was an attractive space to add. Thus, we did increase the allocation to the PIMCO strategy. It was last year, I believe, we added. That was the first increase since I started.
Thank you.
Members, any other questions? Oh, Trustee Wahe.
I guess, I don't know if, maybe I should ask Ryan this question. So at the Commonfund conference, usually I attend all the private equity area workshops because that's what they're known for. This last one, I went to the private credit. That was the first time I heard from guys who are extensively in this area. And then even hearing today's presentation, it sounds really like the way they sell it. I mean, you're going to make your interest rate back, or they get the asset when they make the, I don't know, the way the guys made it sound like they make the loan to the various private equities that are that they think they can make work that haven't been working the way they want. And if it still fails, they either get paid back or they get the asset, which sounds very good. And if the return is between 9 and 15%, that's comparable to a private equity investment. So why wouldn't you just, I don't know, put everything into the private credit market?
So do you want to hear right now, John? No, sorry.
So I think definitely one of the benefits of investing in private credit is hopefully, like we said, is the hard asset exposure that you have underlying the investment, right? So unlike private equity where you're literally investing in the equity, right? If you think about, I'll use the housing market as an example, a private equity style version of a house, it would be like, I own the house, right? If you own the house and the value of the house goes down, right, I lose money. But if I'm the lender, if I'm the private credit lender on the house, as long as I don't lend at too high of a loan to value ratio, if the value of the house goes down, I still get my money back, right? So it is a very attractive profile. Some of the challenges are, how far away from being impaired is that loan, right? And so one of the concerns is that you don't actually gave you let too much of the value of the asset against the loan, and that when the value of the asset goes down, you actually lose money. But to the benefit of why I think generally you would want to have, just like within the strategies, we want to highlight diversification within the portfolio, even within private credit. We wouldn't put all of our money into just housing related assets, right? Even in this context of this portfolio, right? You might want to have some equity beta as opposed, because values of assets don't always go down. In fact, the equity markets have done quite well in the last few years. And when the value of the asset goes up, you want to have some exposure to positively benefit from upside in asset valuation.
So that's the other thing I think it's important to note here is that this relationship between potential credit returns and potential equity returns are not always kind of at the same level as they are right now. Just so happens that currently the yields within, private credit markets are very, very attractive relative to, what most industry professionals, whether it's investment consultants, whether it's other asset managers, or allocators like yourselves are, the forward projections that they're putting on equity-like returns. But for example, over the last decade, private equity has, offered 15+% returns on an annualized basis. That's very, very attractive. Now you're taking quite a bit of, capital impairment risk to get that. And on a forward-looking basis, I think, most folks would say that that type of return isn't necessarily likely. And so, yeah, we would say that right now the opportunity set in private credit looks very, very attractive on a relative basis.
At the risk of piling on, I only want to add one more comment, which is, we have the good fortune of, we speak with Ryan over conference or VC probably 5 to 6 times a year. And then we're here on the island 3 to 4 times a year, and often. So the partnership here is real, and the collaboration, to some of the earlier questions about, the engagement. I just want to make sure that's very clear. We have the good fortune there.
Private credit's been around for a while, right? It's nothing new to the. Do we anticipate the banks getting back into private credit? Because right now they're saying, on the panel that we sat in on a recent conference, basically they don't see, these private equity companies don't see the banks being a big competitor right now. But do you see the banks getting back into it, and do you see it potentially affecting the outcome?
Yeah, that's a great question. Actually, we get that question a lot, especially
Thank you.
Especially lately, right? Because one of the things that's obviously most relevant to change in the conditions of the United States is you have a new administration, right? And what is the new administration going to do, and how does that impact how banks behave? One of the important things we tried to highlight in the deck is that the opportunity in private credit was created in large part due to changes in the regulatory environment, right? New regulations that were put on the book. And what I would try to emphasize is that what we've seen so far, and certainly we have a long road ahead of us, what we've seen so far has been a rollback in what I would call regulatory enforcement, right? Meaning that, the penalties, if you're violating the laws, maybe are going to be less over the next few years, right? There's going to be less of a focus on going after bad actors, but that doesn't actually change the laws on the books, right? Changing the laws on the book is actually very challenging. It's very difficult. And so if you're a bank, to address your question, you say, well, should I get back into this market? Well, maybe in the very, very short term, say the next 4 years, right? maybe the risk of me getting back into that market is less than it otherwise would be. But it doesn't change the fact that the law of this country is still the law. These acronyms that we had on one of the pages, that's still the law, right? And when the administration changes again, there may be a different action. And so the risk to the banks of getting back in the market is just that the regulatory enforcement environment changes before the laws itself change. And so we think banks will continue to be cautious, at least in the short term.
Trustee Wahe. Any other questions? All right. Trustee Alaba, just your mic. Yes.
Yes.
No.
Are there any differences in asset-based lending to traditional?
I mean, some of the disadvantages are, one of the disadvantages I think is that you have, at least in the consumer space, that you have exposure directly to the consumer and the consumer behavior. Although it's very predictable, and we spend a lot of time and resources at PIMCO developing models. One of the risks in investing in consumer asset classes is that, just like we talked about with the regulatory environment, every 4 years, consumers in the United States become voters, right? And so there's always, policy risk related to consumers. And so, give you some examples, just in the last couple of years, there was a lot of noise and a lot of tension given during the prior administration about student loan debt forgiveness, right? And so when you're investing in consumer asset classes, you can write models, you can create, predictions on losses on your portfolios, but the models are always backwards looking. They look at what happened in the past when the economy changed. It's very hard to predict what the policy outcomes might change and how policy might influence consumer behavior. And so that's a risk factor. The way that we try and address it at PIMCO, right, is not just being, what we call quantitative, right, where we use computer models to evaluate what our loans might do, but also to overlay a qualitative angle to it as well. And what that means is that, we have resources at PIMCO who spend a lot of time in Washington talking to policymakers. So we have a woman named Libby Cantrell who runs our public policy group. She's frequently on CNBC. If you ever have time to watch during the day, you might see her one time. But her whole job is going to Washington, talking to the policymakers, talking to senators, congresspeople about what they're thinking about how they might want to change the law and change it. And so the goal for us is to try to be ahead of changes in the law so that we can avoid those types of risks.
Oh, Trustee Kaka.
Under specialty finance with tech lending, could you share some examples of the companies that have been yielding highly and those that have not, and the various high tech companies that we're invested in?
Yeah, so within tech lending, when we talk about tech lending in this context, we're not talking about lending directly to the companies. What we're actually referring to is actually lending to employees of companies that have private stock and lending against the value of their company. So if you are an employee at a private company, right, that's not a Google or Microsoft, that has yet to go public, part of your compensation might be stock grants in that company. The expectation over time is that if you're an employee at this company, that over time, if the company does well, that company might go public, and you might be able to sell that stock in the public market. But what do you do in the meantime, right? How do you monetize? And as the value of some of these tech companies have grown without going public, right? Employees also, they want liquidity. They want to use some of that cash to spend money on consumer assets, buy a new home. So the types of lending programs that we're doing are basically lending to employees of a diversified portfolio of private companies against the value of their underlying stock.
Can you share some of the?
Probably not.
Oh, okay.
And members, I appreciate your questions. I know you guys got to run. So Jason, Kevin, and Bill, appreciate it. Thank you so much. Trustees, if you guys have any more questions in the future, I would encourage you to reach out to Ryan, and Ryan can make the connection or get you your answer as well. And we look forward to seeing you guys again down here and giving us an update. Appreciate you guys being here.
Thank you very much for the
Thank
time
you
tonight.
so
Appreciate
much.
it.
Thank you. Aloha. All right, members, moving on to the next order of business, new business. Informational briefing, OHA Delegation recap of Commonfund Forum, March 8th to 11th, 2025. Key investment insights and takeaways. Do we have anyone signed up to testify on this item?
Somebody joined, but it doesn't look like they're raising their hands, so no testifiers for this item.
Okay, there are no testifiers for this item. So the delegation that traveled up to Commonfund, as we all know, was Kūpahu-Marino, Stacey Ferreira, Treasury Director, Ryan Lee, Vice Chair, ILM Committee, John Wahe'e, Trustee Kele BAE Vice Chair, and myself. And I'm going to let Ryan take it away. It was a great opportunity. I just want to start off by saying I think this year versus prior years that we attended, it was more, I mean, of course, it was more, what do you call? It was more personable, one-on-one. We had opportunities. Yeah, it was more customized, and I appreciate Ryan actually setting that up and communicating that to them ahead of time. Yeah, go ahead, Ryan. Take it away.
Yeah, so my comments reflects my takeaways in terms of the impact to the Native Hawaiian Trust Fund portfolio. This year's conference, covered a broad range of investment topics from global economic trends and shifts in private equity venture to the growing impact of AI, right? So my comments just reflect just the main takeaways I thought would be helpful. As you know, first off, the key takeaway there was sort of the market uncertainty, right, about policy risk. As you know, over the last 30 days, the market's been pretty volatile. S&P has corrected, was down almost 10% at one point before recovering, right? So what the uncertainty in the market is definitely going to create a lot of short-term volatility. So you can expect performance to be volatile. They talked about global inflation, global growth actually being pretty decent, 2.7%. But there's a lot of uncertainty within inflation, high interest rates, and geopolitical instability. U.S. is expected to lead this global growth, but consumer confidence is starting to weaken, right? Increasing the likelihood of inflation, which is estimated to be at 40%. So it's not a high probability, but it just has increased over the last couple of weeks, right? So trade policies, tariffs, reduced immigration could even increase further pressures on inflation. So eliminating the Fed's ability to cut rates. So that's sort of the craziness within the market uncertainty. In terms of key point number 2, I'm going to jump to 3, which is sort of the fixed income revaluation I thought was interesting. Historically, fixed income has served as a key portfolio diversifying portfolios. However, with rising U.S. debt levels and increasing treasury issuance, this could drive yields higher, potentially reducing the fixed income's effectiveness as diversification tool. So that's something that in terms of the asset allocation with the Native Hawaiian Trust Fund, we should be considering on a go-forward basis. The panelists talked about how investors can manage this issue. For example, looking at shorter duration bonds to reduce interest rate risk, global fixed income to diversify away from U.S. fiscal risk, and so forth. And lastly, again, just really highlighting the importance of portfolio diversification, especially within the short-term volatility. So basically, a well-diversified portfolio would help mitigate some of the economic, inflationary, and geopolitical risk. You heard from PIMCO in terms of expanding to different strategies, right? So expand beyond traditional fixed income and equities, such as private credit, infrastructure, for stable income-generating investments. Look at AI. There's lots of talk about AI in terms of the future growth, right? So AI technology for long-term growth opportunities within innovation-driven sectors, as well as focus on sectors that are benefiting from deregulation and government investment. So those sort of the takeaways from from an investment lens, but I definitely would look to my colleagues
Yeah.
to share their takeaways as well.
I'm gonna actually call on Stacy next. I know there's some great questions you had asked over there in regards to the CPI and stuff like that. So if you could address that, Stace.
Absolutely. Mahalo, Chair. So again, I was very grateful. Mahalo trustees for allowing me to attend the conference. I learned a lot. I especially enjoyed the one-on-one customization of the sessions that we had with the asset managers. You know, when you meet with each one of them, they make it sound so good. Like you want to put all of our money into, you know, a specific asset class. But I appreciated the customization that we had with them and not going through necessarily a slide deck, but really being able to ask questions so that we could baseline our understanding around our portfolio, our investments that we're making in these particular strategies. So one of the questions that I did ask was our current policy on CPI plus 2.5. As we know, the CPI is based off of a national CPI. But when I think about Hawaii, we are a unique market. And so I've asked Ryan to work with Zoe, who is our new Common Fund representative, to model out what a CPI would look like based off of a Hawaii Consumer Price Index. You know, by doing this modeling, I think that we're going to find that, again, cost of business is just, it's higher because of the, you know, of where we live. And, you know, we want to make sure that we can keep up with the cost of living and that, you know, what we're spending on, we actually can have greater purchasing power in the marketplace. So that's one of the follow-up items that we're going to take away from Common Fund. And then one of the things, and you know, what we heard consistently from the asset managers is that Ryan needs help. He's a one-man team and he really needs additional assistance. Again, if we want to see the kinds of returns to get us to that $1 billion mark, we're going to have to invest and we're going to have to put time, energy, and effort into it. And that's going to require some additional assistance.
Absolutely agree. And getting back to that CPI, I guess just some numbers from 2024, 3.9% Hawaii versus 3.2 in the US. So we got to take that into consideration as far as allocation, right? Increase our allocation to make up those numbers. Go ahead.
Yeah, so what that really means is that we need to target a high return,
Mhm.
you know, for the portfolio, which means, you know, taking more risk to kind of get there,
Mhm.
right? So we can model that out, but I think the outcome would be just that we need to take more risk to generate the returns that we need.
Right.
Question. Would those risks involved the area of AI and technology?
I mean, that part of AI would sort of sit within the venture portfolio. So there would be opportunities to allocate, right, to AI through our venture managers that we identify.
Yeah, AI, and we talked about up there as well, especially the real estate side, the infrastructure for the AI as well. Trustee Akaka.
So to continue what they were sharing, and when you're talking about how Ryan needs more help, part of the conversation in that private meeting that we had with Joe and Zoe was he doesn't have an analyst. So we're looking at how can we build up our team to have it where if we are hoping to have a higher yield or higher outcomes, we need to be able to provide Ryan with the tools to do so and the team to perform as we hope to get. So I shared with you folks before we got into this meeting a copy of the conference agenda and the sessions that we attended so that you folks can get a glance into what our agenda looked like and the different sessions that were provided to us and the keynote speaking and so forth. And if you have any questions, I'm happy to answer. Well, there was so much, I would say with each Common Fund a forum, there are great takeaways. In my experience through the years, couple years back, there was just last year, there was, I had mentioned prior, is that super genius robot, Sophia, and what that meant with AI and how what that means for us as Hawaiian people in terms of being ahead of the game and having the correct information out there. And then in years prior, with Common Fund, we learned of that we hadn't made a commitment in so many years. We've done fairly well considering with the market, but that had yet to be done. The other big takeaway was that because the current structure that we are currently in, we are no longer an OCIO. The decision was made that Joe, being that his sole focus at the Common Fund is under the OCIO structure, it made sense for us to now be working with Zoe, who was in that private meeting where it was Joe and Zoe, and they went over various topics. And I too am very thankful that in this Common Fund, which was unlike any other, it seems each year provides a different set of information and opportunity. With this one, it was very, the term was used earlier, customized, and it was geared to us learning more about what opportunity that we can make use of through their relationships that they have with various entities. And some of the ones that they spoke to us about were secondaries and venture capital. And this was maybe one of the most excited I've gotten with Common Fund in my capacity in my years here, because they shared with us all the possibilities current day and what they're doing to make it so attractive and why it's so high yield, and what that means with AI, and also what it means with their investments with these big tech companies and why it's so attractive. So after that, I did adjust my schedule with the sessions that I was attending so that I could attend the Venture Direct and Venture Capital, because I got really excited about that. So the different sessions that I chose because I felt it was mission aligned, strategic plan aligned. And then after that private meeting, I thought, well, geez, like this is another set of lens that we have that I think that we can be more active on. And that's what really was a huge takeaway. The other big takeaway for me was in having a real upfront, honest conversation. So in terms of what we can do as within our mission, our strategic plan, and the goals that we have, why we even exist is we work with Common Fund, we work with JP Morgan, we work with Goldman Sachs, but not to limit ourselves just to attending investment training or a forum with Common Fund, but please do make use of being able to have private meetings and attend what these different entities that we're investing with, the managers, and attend, this is Common Fund telling us that, say, hey, you know, look at JP Morgan, look at Goldman Sachs, and see what they're offering you and see how it makes sense for you and how best to move forward. And I thought I really appreciated that perspective that they gave. And let's see, it was interesting too what Ryan had touched upon when they in the different sessions and the keynotes, they talked about the realities of the geopolitical times that we're living in. And it was interesting because the subject matter that they were discussing, and when the different panelists were asked, well, what could happen within the next day or 2 or 3 or week or months or year, some of the things that they had predicted happened within hours. And we could see news alerts coming through. And I thought the timing was very interesting on that. But that's one of the big things that I appreciate in attending as a fiduciary these investment trainings, is because it helps us, it allows us to be able to keep on with what the markets are telling us and what our managers are faced with the decisions that they have, and how we can support them best in our roles. So it's more of, we are more in sync with each other. And I was so, I was really, really thinking that, well, hey, what does the next year look for us in terms of our investment training? You know, how can we maximize on this? And looking at where the market is going, clearly AI and big tech is where it's at.
Mhm.
And venture capital is one of the big things for us to really make use of, but not limit ourselves to that. When it comes to diversifying, we look at secondaries, we look at venture capital, we look at privates, all that stuff. So hope that explains.
That was great.
Yeah.
One thing that I want to touch on as well. So Zoe Brazilara, she's our new point of contact there. Joel Falcha, who we all know, Joe's a great guy. He was our OCIO, but he did say that it didn't make sense for him to be a part of this equation anymore. He's very sad. He's very sad, but now the board took a different approach as far as the policy, right? The manager approach is what we were at. And so he's no longer going to be involved, but Zoe's great. We did request some information from her that we'll be presenting back to the board as well, in regards to the CPI. I particularly was interested. Well, I also want to say one other thing in communicating with Joe and Commonfund. I don't think we were able, and this is my honest opinion after being there, I don't think we were able to maximize the potential of this portfolio, being that we did not. There came a certain point where OHA didn't really give them full discretion over the portfolio. And honestly, looking around the room, there's no one here. This is prior to us being here. And so at that point, I don't think they could really get to work. And so now we have Ryan, he's getting to work, but as Stacey mentioned earlier, we've got to build his team. So I look forward to that. I want to point out one thing, because I know we covered a lot, especially in the private stuff earlier. To me, the navigating today's commercial real estate markets, if you look at the schedule, that was, to me, the highlight, aside from venture and private market credits. But they addressed the three people on the panel. One of them was invested in self-storage units, which she claims that's the best business ever, right? And in any market, even during COVID. Also shopping centers, as well as kupuna housing. That was another one. So to me, I thought that panel pertained more so to OHA. And so my key takeaway was like, moving in that direction potentially. And then we also asked the question about how involved is Commonfund in the Hawaii market, right? And the answer we got, we're not. You know what I mean? So if we ask Goldman Sachs the same thing, or JP Morgan, they'll probably say the same thing, right? Identifying venture opportunities in Hawaii, I think that's what we're kind of looking at next.
More international,
Yeah.
national.
So that's just the takeaways. And John, anything to add?
No, but my favorite workshop was the private credit
Yeah.
one.
Yeah.
And also, I learned, keep your promises.
Yeah. And I just want to say there'll be more opportunities. We identified other opportunities as far as training sessions for the other members of this board. So we'll send them out when the dates come up, and look forward to having you guys attend those. Trustee Aquino.
Thank you, Chair. I appreciate the upcoming list of opportunities. I'm wondering if we could kind of accelerate putting one together in order to take advantage of our budget planning process for the trustee suite.
Yeah, for sure. Yeah. We're actually working on that.
Great.
Right now, as far as our budget, that's due tomorrow.
You're on top of it. Thank
We're
you.
on top of it. It's on. Yeah.
I just wanted to answer Trustee Alapa's question on what does that mean when Trustee Wahehe says keeping our promises. So there was a young man, his name was Alex Sheen, and he was an amazing speaker. So all of the keynotes were actually leadership development type speeches, and this particular gentleman got a standing ovation because he was that incredible of a storyteller. But basically a young man who lost his father to cancer, and one of the qualities of his father was his ability to keep a promise. And so his whole speech was around how important it is as leaders to be integrous to our word. When we make a promise to say, it's easy to say we're going to do something and not follow through. And that's because we don't like to say no, or we overpromise thinking that we can, or sometimes we just say it, because we have good intentions, but we don't follow through. And at the end of the day, as leaders, all we have is our integrity and our honor. And what he developed as a result of his father's death, he gave a eulogy. He passed out these promise cards. It looks like a little business card, and it was blank. And at the very bottom, it says, because I said I would. And so the challenge, or the card that he gave to the individuals at the funeral, was to make a promise to somebody. And you say, this is my property and I give this to you freely. This is a promise that I make to you. And when I fulfill this promise, I'm going to come back and I'm going to get it back from you because it is my property, but it is also my fulfillment of my word to you and whatever I was going to do. And it was beautiful. And it was his way to honor his father. But more so, it has really created a social movement where it has become, he's created a nonprofit that's called Because I Said I Would. And it actually teaches folks around the world about resilience, really. So yeah, so there were many stories about folks that had done these promise cards. He first promised 10 cards to be sent to the first 10 people to DM him in his Instagram. And now he's over 1 million promise cards later in over 150 countries. It was an absolute amazing story. You can watch him on TEDx, Alex Shane, Because I Said I Would.
I'll look it up. Go, Trustee. Thank you, Stacy.
In the printout that I shared with you all, if you look on page 5, that's what's being discussed. This young man named Alex Sheen who started Because I Said I Would. I think it's safe to say that those of all backgrounds, age range, and so forth, there were a lot of faces being wiped during this this keynote speaker, and wow, it was very incredibly impactful. And I think I was thinking when he was presenting, like, how can this be applied into the work that we do? And I thought of different organizations that we provide kokua to with grants and so forth, and what they stand for, and how impactful what his words are and his sharings, and why his nonprofit exists, how that would be in alignment with what they do and so much of what we stand for in our mission. But yeah, it was so powerful. I recommend that you folks, if you're able to, watch his TED. It's one of the best I have ever attended.
For sure.
Maybe the best.
Mahalo trustees, mahalo members. If there are no other questions, we're going to move on to the last item of business. We're going to have an informational briefing by OHA Land Department on the following properties: Kele o Puna, Hawaiʻi Island, TMK 12010, number 1, 2, and 10, and also 003. Anyone signed up to testify on this item?
Yes, we have someone signed up. It's Jermaine Myers. I'm bringing her over to the main.
Okay.
Oh, was my name called while I was in the pause section? Oh.
Aloha, Jermaine.
Aloha. I'm not sure if you called me while I was going out of the panel and back in.
No. We just called you now.
Oh, okay. Is it okay to give testimony now?
Yeah, could you get closer to your mic? I'm not sure if that's our end or on your computer.
Oh, okay. Can you hear me now?
Can we bring her up? Hold on 1 second, Jermaine. We're going to try to bring you up over here.
Thank you.
Go ahead.
Okay, awesome.
Okay, we can hear you. Mahalo, Jermaine.
Thank you. Aloha, my name is Jermaine Myers. I'm an OHA beneficiary for beneficiary advocacy and empowerment. I'm also a Nanakuli Hawaiian homestead lessee. Mahalo for the opportunity to speak on Kele o Puna. I noticed that OHA had obtained this, took ownership of this property back in 2005 or thereafter. So it's been 20 years. And I'm looking forward to hearing the presentation. I saw in the packet that the mission is to provide Native Hawaiians and the broader community with opportunities to interact with Kele o Puna meaningfully and reciprocally, educate the community about the importance of Aina and the benefits of engaging with Aina, steward Kele o Puna through the application of the Hawaiian culture perspective. I'm looking forward to it because I did see that there was partnerships in one of the slides. I didn't see Department, oh, there it is, Department of Education right there. And the point that I'm making is that I was wondering in the presentation if you engage neighbor islands such as Oahu, schools on Oahu. In Nanakuli Homestead, there's 1,000 homestead lots. Going up Nanakuli Avenue and Haleakala Avenue, Mauka to Makai, or Makai to Mauka, we have 3 schools, Nanaikapono L, Nanakuli L, and Nanakuli High and Intermediate School. This year, we have a combined, for those 3 schools, we have combined registered students of 1,900. When you add that to another school, Hawaiian Immersion School Kawaihona on Farrington Highway, but it is on homestead land as well. It is a lease to DHHL. They have this year 700 students registered. So when you combine that, that's 2,600 students from K through high school, K through 12. If each one of them have a one parent only, that's an impact of 5,200. If each of those students had two parents, that would be an impact of 7,800. The only other Hawaiian emergent school in Waianae-Moku is Kamaile Elementary. And they have this year registered 900 students.
Jermaine.
So the point I'm trying, yes?
Oh, ikalamai.
Okay.
No, sorry. Is this in regards to Waukeleo Puna?
It is because it's related to the if there is curriculum. And so I'm asking, bringing it forth to your knowledge about how many students I have in my community. And I'm wondering if that's OHA's direction. I saw the the alignment with Mana I Maoli Ola and all of its goals. So do you have a question to me about how I feel that it could impact our community? Or
Yes. Is this in regards to the surrounding areas in Waukeleo Puna? Because this current
I didn't see in the
agenda item has nothing to do
presentation.
with the education part.
Oh, it does say that what the mission of, or what was the vision of that land when OHA took ownership 20 years ago. So has that changed? Am I reading something wrong in the packet of the intention of that land?
Maybe Laurie can clarify. Laurie, if Jermaine, you don't mind if we.
You know what? Why don't you go into your presentation? The point I'm trying to make is
Yeah.
that I saw on your slide that you have Department of Education, and I was trying to find out if in your presentation there were more slides than this in order to allow us to understand if you're trying to impact us statewide or if that parcel of land was only meant to impact those on the Big Island, as far as because it said it was global as well. The vision was global impact, not just locally. So I'm just trying to get you and the trustees to see my community and how you could impact my community with having potential workshops there to bring excursion from the students in my community to go to the Big Island. When we were in school, when we have experiences outside of what our family affords us, it gives us broader understanding of the world around us.
Understand, Jermaine. Thank you very much. We'll let Laurie proceed. Thank you for your testimony. We'll let Laurie proceed with her
Well, you
testimony.
interrupted my testimony, so
we'll let
I
Laurie
lost track of
proceed.
my thought. Okay, no problem.
Sorry, Jermaine, we're just trying to find out how that was connected. I just want to make sure we stick to the agenda because some people call us out on sunshine law, so we just want to make sure. Thank you.
Chair, you don't have to be
Yes.
sarcastic about it because I understand what sunshine law is, and I think if you
Jermaine, I'm not being sarcastic at all. I apologize, but we had to cut it off, and we have to make sure that we were covering our end and make sure that we're not doing anything that's not on the agenda. And as the chair of this committee, what I see is that had nothing to do with Waukeleo Puna. Mahalo.
Aloha, aloha nui kako. Mahalo, Jermaine, for your testimony. I will tie that into my presentation. Aloha, Chair Souza, Vice Chair Waihe'e, and members of the board. Today, we continue our series of informational briefings on our Aina portfolio as we travel to our Hawaiʻi Island forest, affectionately called Waukeleo Puna. Kele is the designation of this 25,856 acre low-lying wet forest, considered to be the largest intact tropical lowland rainforest in the context of the United States. Nearly the size of Kahoʻolawe, Waukeleo Puna lies within the ahupua'a of Waiakahiula and Ka'ohe in Puna on Hawaiʻi Island, flanked by the ahupua'a of Kamoamoa and Keonepoko. It also sits on the east rift zone of Kilauea volcano, less than 3 miles downslope of Pu'uo'o, whose 2014 flow traveled across our Waukele lands. Next slide. Under previous ownership, a period of attempted development practices that threatened forest loss and inaccessibility to forest resources served as a reminder of the vulnerability of the natural and cultural resources of this storied landscape. Oh, we're not there yet. Previous slide model. When we acquired the forest reserve in 2006, it was recognized as the first official return of ceded lands to a Hawaiian entity. The purposes of acquisition listed here were to 1, protect the natural and cultural resources of these lands, 2, to protect traditional and customary rights of our beneficiaries on this land, and 3, to ensure these lands are passed to the Lahui at the time a sovereign entity is stood up. The title was secured in 2006 in partnership with Trust for Public Land and DLNR Department of Forestry and Wildlife through a grant opportunity funded by the Federal Forest Legacy Program. Next slide. While Kele Puna is designated a state forest reserve, state conservation protective subzone, the most restrictive zoning designation protection by the Land Use Commission. It is one of few remaining tracts of lowland rainforest in Hawaii and the U.S. It is a watershed recharge, as while Kele Puna lies over 20% of the largest aquifer in the state, the Pahoa Aquifer. It is a habitat for rare and endangered species, as well as a seed bank for forest restoration. As with all Vahikupuna, while Kele Puna is a sacred place to our beneficiaries where their rights to exercise traditional and customary practices were asserted and continue to be protected. Today, Pele continues to dance across Puna, accelerating the life cycles that characterize this storied landscape. Kane lives here, and stories of Hi'iaka and Kamapua'a reside here as well. Archaeological features are hidden within the extensive network of lava tubes. Upon acquisition, OHA entered into a 10-year MOA with DLNR, who led management of the reserve until 2016. Beginning in 2015, next slide. Beginning in 2015, OHA assembled an ahakuka composed of cultural practitioners, educators, scientists, and conservation and restoration activists, and initiated management planning efforts. The resulting comprehensive management plan was approved by the BOT in 2017, where it established a vision and mission which continue to guide our forest management today. Here is the vision and mission that our testifier was referring to earlier. While Kele Puna will be locally and globally recognized for forest stewardship, conservation, and provision of customary practices through the application of a Native Hawaiian cultural perspective and serve as a model and inspiration for Indigenous communities worldwide. The mission is to provide Native Hawaiians and the broader community with opportunities to interact with Kele Puna meaningfully and reciprocally, to educate the community about the importance of Aina and the benefits of engaging with Aina, to steward Kele Puna through the application of a Hawaiian cultural perspective that integrates traditional and modern Hawaiian science and best practices in conservation while ensuring traditional and customary rights. The primary outcomes of the comprehensive management plan are to 1, engage community in stewardship and management, 2, protect our native species, 3, eradicate invasive species, and 4, includes management of ungulates. Next slide. As our organizational strategies evolve, we reassess our management plan implementation measures to ensure continued alignment. As we know, the health and well-being of our lahui is inextricably linked to the health of our lands And we continue to prioritize connecting and reconnecting Kanakatu Aina through education and stewardship opportunities at Waukeleo Puna. While Waukele's restrictive zoning classification currently limits our programming to conservation and education or research activities, our operations seek to expand alignment to outcome 8.2, the establishment of new markets for Native Hawaiian products, as we explore more agricultural practices with food production and revenue generating opportunities to help sustain our stewardship. Next slide. Implementation of the CMP at Waukele necessarily exercises a multifaceted co-stewardship model to achieve our management objectives. We have numerous relationships with public and private entities, including Three Mountain Alliance, Department of Forestry and Wildlife, the Nature Conservancy, U.S. Fish and Wildlife Services, Hawaii Volcanoes National Park, the University of Hawaii at Hilo, and many more, as you can see here. We also initiated a community network of practitioners and educators, which we refer to as our AHA Kaiaulu, as an extension of the original AHA Kuka. This growing network of community stewards helps to expand our impact. Next slide. One of the major challenges we experience is the invasive species that are prolific across the reserve, as these invasives outcompete our native species for survival. Our forest management operations focus on intentional removal of the invasives, immediate outplanting of natives, and consistent maintenance to restore the integrity of the forest. Of course, rapid ohia death poses an additional layer of challenge. Through partnerships with researchers, education, and desanitization protocols, we are rigorous about managing the spread. Additionally, the restrictive zoning and 3 total access points for the entire 26,000 acres limits our management activities. Surely, but incrementally, we are increasing the footprint of managed area. Next slide, please. Engagement with our communities, predominantly schools from the surrounding school districts, including Ka'u, Kea'au, and Pahoa, is another primary management practice that, one, fosters increased interaction between our beneficiaries and our lands, which we know yields positive health outcomes, and 2, expands awareness of and accountability to our forest and its vulnerable resources. Targeted engagement with our schools aims to instill a sense of kuleana to malama our places at an early age, with the hope of influencing healthy shifts in current and future family systems. The kids will practice kilo on top of the 2014 lava flow, observing and building relationship to the natural systems of their environment. They also participate in hands-on native habitat and species rehabilitation activities, including sorting and preparing seeds for outplanting in one of 4 managed fence units near the engagement area. Next slide, please. In 2023, we were able to add 17 acres to the managed fenced areas on the reserve when we were awarded a $230,000 grant from Fish and Wildlife Services to construct an ungulate fence around the rim of Pu'uheheia Hulu to protect rare and endangered species identified within the crater. In partnership with the Plant Extinction Prevention Program, we have done recon missions into the crater to gather cuttings of rare species found only to exist in our forest. The cuttings are being propagated at the Volcano Rare Plant Nursery, and once established, we'll be able to outplant them back into the forest. Next slide. Beginning in 2023, our partners Trust for Public Lands and the Department of Forestry and Wildlife presented us with another Forest Legacy Program grant opportunity that would position OHA to expand our Waukeleo Puna footprint of forest protection by 1,900 acres of adjacent forest, recently on the market. The adjacent lands also offer more access points into our currently landlocked Puna property, thereby increasing opportunities to explore more programming such as community-based food sovereignty programs without the restrictions of the protective subzone designation. Additionally, these lands are vulnerable to impending deforestation. As you can see in the image to the left, there is a neighboring rock quarry with an all but leveled pu'u directly next to an untouched pu'u, which we believe harbors rare and endangered species. After a year of development, we recently submitted the grant application. In this political climate, though, our chances of being awarded this federal grant are highly uncertain. However, in the event we are awarded, we would find this out in August of this year, at which time we'll come back to present the envisioned management plan to this board for approval to accept the grant and proceed with due diligence of a potential acquisition. Additionally, we are in the development of our CMP, the Comprehensive Management Plan. The single most frequent community recommendation was to establish a cultural meeting place at Puna. This board in fiscal year 25 approved funding to construct facilities that would enhance our engagement activities, and those should be completed later this calendar year. These facilities include an environmental toilet, covered gathering space, and the establishment of a cultivation area for cultural practices. Should logistics allow, we would be happy to host the Hawaii Island Board meeting this September in our own forest. I wanted to also circle back to our testifiers' comment and request for engagement opportunities. The remote nature of this this forest, as well as the designation, the zoning designation that's highly restrictive and protective, intentionally so, doesn't allow for more than 20 or 30 people at a time, for us to host that many people at a time. And so for this forest, we're very our cadence is limited to the amount of people we can host, but we do have opportunities in Wahiawa, at our Wahiawa lands, to engage our communities on Oahu Island. And so definitely reach out to us, reach out to Hawaiian Civic Club of Wahiawa, and we can coordinate stuff for students on this island. And with that, that concludes this presentation. If there are any questions, I'd be happy to answer.
Mahalo, Lori. Great presentation. Trustee Akaka.
That last slide that you're still on, and that that area, former pool area, is that Lehua forest, or has there been a survey of that to see what species are there?
We haven't done the survey yet, but that would probably be included in the due diligence portion of exploring an acquisition.
Yeah, I would be interested in what you folks find with that survey, to see what type of plants were possibly affected there, and what it is, and how that would be how we could implement that and put that into advocacy, and then part of our community engagement on the challenges that we have with our rare and native and the endemic nature that we're working with here. But how large is this span of affected area, and then that neighboring pool? It's like a square mile? Or?
It's the total area. So in that center image, you can see that larger orange outline. That's Puna. That's the forest reserve that we currently have in our land holdings. And to the right of that is that yellow outlined area. That's about 1,900 acres. So Kele is close to 40 square miles.
Oh, but the affected area, how large is that?
The pu'u itself?
Yeah.
I don't know the size of it, but no, it's not. It's
Like
not a mile.
Kuva'a size?
I'm not sure, but if you've been to like a rock quarry, It's about the size of a rock quarry.
It looks like a big space.
Yeah, I'm not sure what if you go to the previous slide, that's Pu'uheheauhulu, and that's a 17-acre pu'u. So similar in size.
When did we find out that this has been decimated to this point, or did we see any indication of this within the last few to several years?
That's been an operating rock quarry for a long time. I think that our knowledge of the neighboring pu'u just came up when we learned about this opportunity.
Okay. So it's the pu'u that's affected, not so this is a quarry I'm looking at.
So the quarry once was a pu'u, so you can see visually what it could look like
Is
on
this
the
like
untouched one.
ancient or more modern sourcing?
The
Quarry?
Oh, yeah, modern, more modern.
modern.
Yeah.
And this was formerly state land?
I don't know about that property actually, but the one we're looking at is privately owned.
Wow. Thanks. I'm interested in learning more what you.
Thank you, mahalo.
Thank you.
Other questions? Trustee Lindsay.
In your report, you mentioned something about going into the crater to get what?
So
I didn't think the crater was, we're able to go into it, right?
it takes a little bit of scaling. We did go down when it was really rainy with this gentleman in the image there. He works for a plant extinction prevention program within DLNR, and we were able to find the rare species that are found that are endemic to Kele, and we're able to take cuttings out of the forest and then propagate them in a plant nursery.
Wow, I'm impressed.
Members, any other questions? All right, mahalo, Laurie. Thank you so much to you and your team for putting this presentation together and for the update. All right, members, there's one more thing on the agenda. But before that, one last matter. I just want to thank Jermaine for her earlier testimony. Just want to also add that the 5-minute period did end as asked Laurie to proceed with her presentation. But Jermaine, we always appreciate you. And thank you for coming down. I just want to make sure that everyone understands that when the ILM chair, or any chair for that matter, cuts anyone off, we're just making sure we're proceeding correctly. And Jermaine, we appreciate you always holding us accountable. I apologize if I offended you in any way. And that being said, members, do I have a motion to adjourn? Moved by Trustee Wahe'e, seconded by Trustee Lindsay. Can I get a roll call vote, Kawi?
Trustee Ahuna is excused. Trustee Akaka.
Aye.
Trustee Akina.
Aye.
Trustee Alapa. Aye. Trustee Galuteria.
Aye.
Chair Kahele. Trustee Lindsay. Vice Chair Wahe'e.
Yes.
And Chair Souza.
Aye. Mahalo, this meeting is adjourned. Yes, sir.